Hey everyone, welcome back to Corporate Decoder, the place where we tear apart company documents and try to find the hidden treasures and not so hidden problems. Today we are diving into a filing from the Federal Home Loan Bank of Pittsburgh, and let me tell ya, it looks like they might be playing a complex game with money. Imagine a bank that doesn't really take deposits from you and me, but gets its money by selling special IOs to big investors. That is kind of what the Federal Home Loan Bank of Pittsburgh, or FHLBank as we'll call it, does. They're not your typical bank, and this report is giving us a peek into some of their financial dealings. Stick around because we're going to decode what this means. Also, before we dive into the nitty gritty, if you like getting these straightforward breakdowns of corporate filings, make sure you hit that subscribe button. And for those who want to join a community of like-minded folks dissecting business news, we've got a Discord server linked in the description below. So, the FHL Bank has put out a report, a current report to be exact, dated the 10th of October 2025. This is a regular quarterly or yearly check but something they file when specific important things happen. This particular report is called a Form 8K. Think of it as a current events report for publicly traded companies. When something big happens that investors need to know about quickly, they file this. Now, who exactly is the Federal Home Loan Bank of Pittsburgh? It is a federally chartered corporation, meaning it has a special status granted by the government. Importantly, it's part of a larger network of federal home loan banks across the country. These banks have a unique role. They are regulated by the Federal Housing Finance Agency, which they call the Finance Agency. The FHL Bank itself doesn't take deposits from you or me. Instead, it raises money by selling debt. This is a really key point. The money the FHL Bank raises comes from selling something called consolidated obligations. These are basically bonds and notes, and they are backed by the financial strength of all 11 federal home loan banks acting together. But here is the kicker. The regulator can force any one FHL bank to help pay off the debt of another, if that other bank can't. This is what they mean by joint and several obligations. This means if one bank defaults, the others can be on the hook to pick up the slack. It is a shared risk, but also a shared burden. So these borrowings, these consolidated obligations, aren't just kept within the FHL banks. They are sold to the public. This means investors like you or me, if we had a lot of money or big investment funds, are essentially lending money to this network of banks. It is super important to understand this part. These IOs are not backed by the US government. So if the entire system of FHL banks were to face severe problems, the investors' money would depend solely on the financial health of those 11 banks. This is standard for many financial institutions, but it is always good to highlight. The main reason the FHL Bank is filing this 8K is under item 2.03, which deals with new financial obligations. They are reporting on the creation of direct financial obligations. Essentially, they are announcing new debt they are taking on or have committed to take on. This is where the real meat is. They are referring to Schedule A as the place where they list these new debt issues. Now they are omitting some details. Specifically, they are not listing short-term discount notes that mature in less than a year, as those are considered routine business. They also mention they'll report any debt they take over from another FHL bank if it has more than a year left until it's due. This is important for understanding the full picture, because new debt is being issued, and potentially they are taking on liabilities that others couldn't manage to pay. This sentence is a little bit of a disclaimer. They are saying they can switch up how they report this stuff whenever they want. This gives them flexibility, but it also means we need to pay close attention to how they present information over time. Although consolidated obligations issuance is material to the FHL Bank, we have not made a judgment as to the materiality of any particular consolidated obligation or obligations. Here is another point of caution. They say that while issuing these debt obligations is important to them overall, they haven't decided if any single debt issue is big enough to be considered material on its own. This means they might be issuing many smaller debts, and none individually might seem like a big deal. But collectively they could be. It is like 1,000 tiny leaks that could eventually sink a ship. Schedule A does not address any interest rate exchange agreements or other derivative instruments which we may enter into as a result of our asset and liability management strategies that may be associated directly or indirectly with one or more of the reported consolidated obligations. They are also being upfront that Schedule A, the list of new debts, does not include any fancy financial tools like interest rate swaps. These are used to manage risk, but they are not listing them here. So we don't see the full picture of their financial risk management strategies in this particular schedule. Scheduler will not enable a reader to track changes in the total consolidated obligations outstanding for which we are the primary obligor, since Scheduler generally excludes consolidated obligation discount notes with a maturity of 1 year or less and does not reflect whether the proceeds from the issuance of the report. Consolidated obligations will be used to, among other things, satisfy called or maturing consolidated obligations. We will report the total consolidated obligations outstanding for which we are the primary obligor in our periodic reports filed with the Securities and Exchange Commission. And this is a crucial limitation. Schedule A isn't meant to show you exactly how much debt they have in total or how that total debt is changing. They exclude short-term debt and don't tell you if the new money is just paying off old debts. You'll have to look at their regular, periodic reports for that bigger number. This report is just about the new specific commitments. The principal amounts reported on schedule represent the principal amount of the reported consolidated obligations at par, which may not correspond to the amounts reported in our financial statements prepared in accordance with generally accepted accounting principles contained in our periodic reports filed with the Securities and Exchange Commission, because the par amount does not account for, among other things, any discount, premiums, or concessions. Finally, they're telling us that the face value or par amount of the debt listed might not be the same as what shows up on their official financial statements. This is because accounting rules can treat things differently, especially when debt is sold at a discount or a premium. So, the numbers you see here aren't necessarily the exact numbers they'll report in their main financial reports. This is the exhibit they're talking about, the actual Schedule A. This is where the detailed list of their new financial obligations should be. Normally, you'd find a detailed list of all exhibits here. For this filing, it seems to be just Schedule A and the standard interactive data tag. And finally, we have the signatures. This is the formal part where authorized people sign off on the report, confirming its accuracy to the best of their knowledge. Here we see the signature block signed by Edward V. Weller, who is the Chief Financial Officer. This tells us that the highest financial authority in the company has reviewed and approved this report about their financial commitments. So, what is the story here? The Federal Home Loan Bank of Pittsburgh is issuing new debt. They are raising money from the capital markets. This is their primary way of operating. What we need to understand is that these are not small amounts of money, and the interconnectedness of the Federal Home Loan Banks means that issues with one bank could affect others. While they aren't showing us the full picture of their total debt or risk management instruments, they are signaling new financial responsibilities. The FHLBank system plays a crucial role in supporting housing finance, but like any institution that deals heavily in debt, its financial health and how it manages those obligations are critical. The fact that they are issuing new debt is normal for their business model, but the details they've chosen to highlight and the details they've chosen to exclude tell a story. They are being transparent about the fact that Schedule A is not the full picture, which forces us to look at their other filings for a complete understanding of their financial standing. This report is a snapshot of new commitments, and it suggests a continued reliance on borrowing to fund their operations, and presumably their lending activities. In terms of assessment, the FHLBank of Pittsburgh, as part of the larger FHLBank system, has a critical but inherently risky business model. Its strength lies in its government charter and its role in housing finance. However, its reliance on continuous access to capital markets for its funding creates a vulnerability. Any disruption in those markets, or any perceived weakness in the FHLBank system as a whole, could make it more expensive or even difficult to raise funds. The primary risk here is systemic, tied to the health of all 11 FHL banks, and the potential for significant financial stress if one or more of the banks were to face severe financial difficulty. There are no immediate red flags suggesting imminent disaster, but the disclosures themselves highlight the complexity and the need for careful oversight. They are managing large sums of money by borrowing, and investors need to trust that this borrowing is backed by sound asset management and sufficient capital. The fact that they explicitly mention they can change their reporting methods is a minor point of concern, but again within the bounds of typical financial disclosures. The key takeaway is that this is a report about debt issuance, a core function, and the FHL Bank continues to actively engage in these financial markets. Alright, that is our breakdown of the Federal Home Loan Bank of Pittsburgh's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussion. Thanks for watching. See you next time.